Implied returns and cash flow additivity explains how investors derive required rates of return, growth expectations, and forward rates from observable market prices and expected cash flows. The topic emphasizes that valuation relationships can be rearranged to solve for implied returns instead of present values. In financial markets, investors often observe asset prices directly, while future cash flows and discount rates must be estimated or inferred. This process allows analysts to determine the return embedded in current market prices and evaluate whether securities are fairly valued. The concepts introduced in this topic form an essential bridge between valuation models and market-based investment analysis. The topic begins with implied returns for fixed income securities. For zero-coupon bonds, the investor's annualized return can be derived from the bond's current price, maturity value, and time to maturity. Similarly, for coupon-paying bonds, the yield to maturity represents the discount rate that equates the present value of all future cash flows with the bond's market price. The topic highlights the inverse relationship between bond prices and yields. When bond prices fall, yields rise, and vice versa. This relationship is fundamental to fixed income analysis because changes in market interest rates directly affect bond valuations and investor returns across debt markets. The topic then applies implied return concepts to equity securities using dividend discount models. Because the required return on equity cannot be directly observed in the market, analysts infer it from stock prices and expected dividend growth. Under the Gordon growth model, the required return equals the expected dividend yield plus the constant growth rate of dividends. This relationship allows investors to estimate market expectations regarding future returns and growth prospects. The model can also be rearranged to calculate the implied growth rate embedded in a stock's current price. These techniques help analysts evaluate whether market prices are consistent with realistic growth and return assumptions. A central concept in this topic is the cash flow additivity principle, which states that the present value of a series of cash flows equals the sum of the present values of each individual cash flow. This principle allows analysts to break complex cash flow streams into simpler components and value them separately. The topic demonstrates this concept using annuities and single lump sum payments, showing that combined present values equal the present value of the original cash flow stream. Cash flow additivity is important because it enables replication strategies and forms the basis for pricing many financial instruments in modern financial markets. The topic further explains that cash flow additivity underlies the no arbitrage principle, also known as the law of one price. According to this principle, two investments with identical future cash flows under all conditions must have the same price today. If identical cash flow streams are priced differently, arbitrage opportunities arise because investors can buy the cheaper asset and sell the more expensive one for riskless profit. Competitive market forces quickly eliminate such price discrepancies. The topic emphasizes that no arbitrage relationships are fundamental to modern finance and are widely used in pricing fixed income securities, foreign exchange contracts, and derivative instruments. Finally, topic introduces applications of cash flow additivity in forward interest rates and forward exchange rates. Forward rates represent interest rates or exchange rates agreed upon today for transactions occurring in the future. By combining spot rates and forward rates, investors ensure equivalent investment strategies produce identical future payoffs. The topic demonstrates how implied forward rates are derived mathematically from observable spot rates using no arbitrage relationships. These concepts are essential in fixed income and foreign exchange markets because they help investors price future borrowing, lending, and currency transactions consistently. Overall, the topic establishes a strong analytical foundation for understanding valuation, arbitrage, and market pricing efficiency.